afternoon to all of our attendees, and welcome to Bourse's first webinar for 2023, first investor webinar. So welcome once again. And today we're taking a look at the first quarter review of both equity and bond markets and providing an update to our investment outlook for 2023. Now, much would have changed from the start of 2023 to throughout the first quarter. And we'd like to perhaps provide some more insight on what changes would have occurred, what the performance of markets would have been, and what investors might expect in the coming months ahead, at least in or through the eyes of Bourse and our investment team here. Now, there are a couple of housekeeping matters which we'd like to just cover. The presentation time today is going to run between 30 to 35 minutes. You can submit your questions at any time throughout the question and answer portal or throughout the chat box if you prefer. There is a very brief investor poll, multiple choice, and we'd really appreciate it if you could complete it to provide some aggregate sentiment of how investors are feeling at this particular point in time and what they might like to see going forward. And of course, we very much value your participation throughout this afternoon's presentation. So please keep those questions coming, and I'll definitely try to answer as many of them as possible together with my team at the end of this session. So as mentioned, today we're going to be looking at that first quarter of 2023 review. We're going to look at the equity outlook, both locally and internationally, as well as the bond market or fixed income outlook, how investors might want to position their portfolios, at least through the eyes of Bourse. And of course, we're going to move to that always valuable question and answer session where we do get very valuable feedback from you, our attendees. So let's get straight into it with that first quarter equity review. Well, when we take a look at that first quarter performance of 2023 from a local/regional perspective, it did not make for very encouraging reading. In fact, all of our indices, whether local, all TNT blended, being the Trinidad and Tobago Composite Index or TTSE in that blue line, the cross-listed index, or the recently launched Caribbean Exchange, or Caribbean Index rather, were all in negative territory over that first quarter of 2023. The All TNT Index declined just about 1.7%. The Trinidad and Tobago Composite Index was down 1.5%. That cross-listed index, which includes names such as Grace Kennedy, NCB, Financial Group, and GMMB, among others, was down just about 1%. And the Caribbean Exchange down 1.1% as well. So it was fairly unidirectional, with the exception of the cross-listed index, which bounced up and down, but ultimately ended lower. And much of that was driven by the performance of its constituent members, of course. When we take a look at some of the major movers on that Trinidad and Tobago Stock Exchange, which would have contributed to that performance of the respective indices, we can see that there was a fair degree of divergence in terms of individual stock performance. So on the outperformer end, we have First Caribbean International, which Bourse would have placed an overweight rating on at the start of 2023, which would have advanced just about 31.5% during that first quarter period. Very attractive valuations relative to the banking sector, improving earnings, dividend yield that is paid, or dividend that is paid in US dollars would have all contributed to investors moving towards that particular stock. Prestige Holdings, after a very challenging 2020 and 2021 fiscal year, their fiscal 2022 was considerably better with no closures or enforced closures, and that would have driven the stock up on improved earnings, of course, up just about 18%. Agostini's Limited continues with its positive march upward in terms of stock price, up 17%, and that would have really been fueled by continued acquisition activity, as well as improving earnings and improving margins. LG Williams B also up 17%, one of the smaller cap names on the Trinidad and Tobago Stock Exchange. And Unilever up 15%, predominantly driven by a very healthy dividend that was declared. which would have taken the stock, which are of north of $2.80 or thereabouts in terms of a dividend that would have been declared. And of course, investors are eagerly anticipating that particular dividend, which comes up in a couple of weeks' time. So on the other end of the scale, there was GMMB, which was down 12%, TTNGL down 13.8%. Investors are, of course, waiting its full year 2022 results. Whitco, which would have posted somewhat disappointing results on the heels of lower revenue and declining margins, down 20.5%. NCBFG, one of the larger names on the banking index, down 22%. And Guardian Media Limited down that 25.2%. Of course, traditional media continues to confront rather the competition or intense competition from alternative media such as social media marketing and distribution channels, which have really challenged those traditional channels that Guardian Media Limited and others would persevere in. When we take a look at international equities, it makes for much different reading, and of course we're focusing on that those yellowish columns, and across the major regions of the US, Europe, Asia, and Latin America in US dollar terms, all of these regions in terms of equity performance were positive and quite positive in fact. The US market, for example, as mentioned by the S&P, was up 7%. European markets up 9.4%, Asia excluding Japan up 3%, despite all of the political tensions and rumblings between China and the US, and Latin America, despite some correction to commodities prices and their own internal political tensions, up 3.6% for that first quarter period. And the usual balance is that the markets would have been climbing a wall of worry, and it certainly seems that way, because of prolonged and persistent inflation, those geopolitical tensions moderating, but still there being some supply chain challenges, among other factors, including financial instability concerns with some recent banking failures in the US and that takeover of Credit Suisse by UBS in Europe. All of those things would have made an investor fairly uneasy, but nevertheless, equity markets would have advanced in that first quarter in comparison to the first quarter of 2022 in that teal color, where most of those regional markets would have declined, with the exception of Latin America, which would have benefited from very, very robust energy and other commodity prices. When we take a closer look at US sector performances, we see that there is a fair degree of divergence. In fact, the three best performing sectors would have been technology, communication services, and consumer discretionary, up in very high double-digit figures. Technology up 21.3%, for example. Consumer discretionary up 15.8%, which comes as some surprise, particularly on the consumer discretionary side, where in an inflationary environment, one would think that investors would really be, or consumers rather, would be focusing on the basic necessities and spending less on those discretionary type items. However, markets have responded in the opposite direction. On the other end of the scale, the energy sector would have had some correction after a very, very robust 2022, and financials continue to slip, down 6.1% over that first quarter of 2023. Now, is that divergence symbolic of different sector performances, or is it just a case of mean revision? Now, as we mentioned, the three best performing sectors on the US would have been technology, communication, services, and consumer discretionary, which coincidentally were among the worst performers in the first quarter of 2022. So there does appear to be some degree of correction in those stock prices and sector performances over that first quarter of 2023. Similarly, energy, which had a very, very excellent first quarter of 2022, up 37.7%, did have that minor correction as mentioned, down 5.3% in the first quarter of 2023. So not really a broad-based advance or decline across all sectors, but there does seem to be some degree of mean revision or price correction across some of the underperforming sectors in 2022 moving into 2023. Now, that was the performance review. When we take a look at the outlook for equity markets, it becomes a bit more interesting. There have been several developments, but let's take a look firstly at that local equity market and some of the market drivers. Now, at the beginning of 2023 and coming into the end of 2022, economic recovery driven by energy production and robust energy prices would have certainly made for a much more rosier outlook for local equity markets in 2023. Now, we have a cautious upward driver factor for those two particular points, given that the economic recovery is still very much hinged on oil and natural gas production and prices. Energy production at the domestic level remains fairly constrained based on the latest available data, and energy prices, global energy prices, have taken somewhat of a nosedive, certainly in terms of natural gas prices over the first quarter of 2023. Inflationary pressures will inevitably be a local equity market driver. There is a question mark, or we have a question mark there, as it will affect different stocks in different ways. Certainly those companies that have a fairly strong degree of pass-through pricing power will be able to maintain their profitability margins and indeed maintain their profitability in an inflationary environment. Those with less pricing power or pass-through pricing power would not fare that as well. Of course, those companies that are publicly listed with a fair amount that are continuing to pursue acquisition activity or value accretive acquisition activity, to be specific, as well as those companies which have some degree of business diversification or regional diversification ought to do well in the coming months of 2023. Now, we just wanted to touch a bit more on that price and production story in terms of natural gas. For fiscal 2023, budgeted production of natural gas is expected to come in at just around 3.0 BCF or billion standard cubic feet per day, as at the end of fiscal 2022, data would have suggested that that production averaged just about 2.7 billion standard cubic feet per day. So there's expected or anticipated to be a 10% odd increase in production. There is no data to indicate that those sorts of improvements are in fact taking place. However, the major change in terms of forecast to the downside would be the budgeted price and the forecast price, in fact, of natural gas. Now, back in September, October of 2022, the Energy Information Administration did forecast that for 2023, natural gas prices would average just around $6 per MMBTU. Fast forward to April of 2023, that forecast has been slashed, in fact, to just about half, where they expect that average natural gas prices for 2023 will be around $3.294 at its latest forecast per MMBTU. So roughly 50% of what was initially forecast and initially, importantly, budgeted in TNT's fiscal budget. So certainly there could be some increasing likelihood that there will be a shortfall in terms of projected revenues from energy related specifically to the natural gas space in the fiscal budget. A fairly similar story on the crude oil side of things. The budgeted price of crude oil was $92.50 per barrel. There was, and currently the Energy Information Administration's forecast is just under $80 per barrel in terms of average crude oil prices for 2023. And again, fairly lackluster production at the domestic level for crude oil. So what does that mean for the local stock market forecast? Well, it means that revisions are likely as of current day. Bourse has not made any changes to its ratings for some of the major stocks which it would forecast for over fiscal 2023. However, as information becomes available in terms of quarterly earnings, we will very likely make updates to our forecast going forward, and these updates may very likely take place towards the middle of 2023 or thereabouts, once as we are in possession of the first calendar quarter earnings for many of these stocks. Now, our initial projection for the Trinidad and Tobago Composite Index over the course of 2023, for example, was a 5.6% advance. When we take a look at that first quarter of 2023 performance, it's actually headed the other way, down 1.5%, perhaps a reflection of investors' confidence or lack thereof, given the very drastic changes in the macroeconomic environment. So revisions are likely to occur. However, there are still several key fundamentally good drivers for those stocks which are in an overweight position by Bourse at the very least. When we turn to our international equity market drivers, there are many moving parts, one of which is cooling US inflation. Now we have this as an upward momentum driver, but with caution with that yellow sign. Given that inflation is doggedly persistent for the time being, it is declining, but perhaps not as quickly as the US Federal Reserve would like it to. That leads to perhaps an extension of when we expect US interest rates to peak. Peaking US interest rates and a turnaround in US interest rates would be beneficial to markets. Generally, when interest rates go down, equity markets tend to do a little bit better. And inflation is somewhat of an indicator, a leading indicator for the direction of policymakers in terms of their interest rates. Supply chain issues, as we mentioned earlier, continue to moderate, and that is generally a good thing for the global economy. Some of the areas of weakness in terms of the forecast and perhaps increased risks to the downside for equity markets internationally would be that financial system vulnerability, which we mentioned. Whether or not the Silicon Valley Bank and other smaller bank failures was a very contained event, or is it an indication of wider vulnerability in the financial system, not just in the US, but across developed nations, remains to be seen. The IMF and the Fed did point to, in their recent publications, the increased risks of recession, and that, of course, would be a damper on investor sentiment and could send markets a bit lower. And those ongoing geopolitical tensions, which are quite black tail or black swan rather, or long tail risk events, and highly unpredictable, could also drive markets lower. Certainly, it wouldn't drive markets higher if geopolitical tensions flare up in the near term. So in terms of our equity investment themes, there haven't been many changes. We still favor for investors at the local level seeking a relative value bias. So don't just buy stocks that are low priced, but buy stocks that are trading at very low valuation multiples, so price to earnings multiples, for example, stocks that offer very relatively attractive dividend yields, stocks that are trading at very relatively attractive market to book ratios. Buying the entire stock market or buying one of each stock may not be the best approach. You have to continue to be very selective, and that's one of the reasons that Bourse provides its ratings across, or for most of the stocks on the Trinidad and Tobago Stock Exchange. So stock selection is going to continue to be important. Looking for stocks with those built-in diversification benefits, whether by business type or whether by regional diversification, is going to be important. And looking for those companies which do have an acquisition pipeline or acquisition plans, or a track record of acquisitions rather, that are accretive, which means they add value and increase earnings per share overall, of course, would be beneficial as well. At the international level, we continue to favor a core satellite strategy. And what do we mean by that? Well, let's tackle the satellite part first, picking some individual names or sectors which include industry leaders. And industry leaders would be those that have dominant share of the market, have been around for a long time, very well established, good governance practices, etc. Buying quality and not hype. So buying those stocks that have proven products, that have proven market share, that have proven network effects, as opposed to the latest and greatest thing to hit the market or IPO. And that was in 2021 a good strategy, when there seemed to have been some investor mania with meme stocks as one example. That bubble has definitely burst. So a quality bias is definitely warranted and encouraged, at least from Bourse's view, in the international space. And when we take a look at that core aspect of the core satellite strategy, gaining broad market exposure, whether through mutual funds or exchange traded funds, which focus on entire markets, is also a good approach, given that it builds in automatically a fair amount of diversification for investors with those very simple additions to your portfolio. So we're going to move on to that fixed income aspect now, the fixed income review and outlook, which is somewhat, at least at the local level, it has been a fairly quiet space. When we take a look at the government of the Republic of Trinidad and Tobago yield curve, we can see that there's been very limited changes in terms of that yield curve over the first 3 months of 2023. There has been a very marginal increase in that 2-year yield from 1.75% to 1.94%. One of the challenges for investors, particularly at the retail or non-institutional level rather, has been access to buying bonds, whether at the short or longer end of the curve. Predominantly, most of the issues have been by a private issuance, and they have been lapped up in large part by institutional investors such as asset managers, insurance companies, etc. So no major changes to that yield curve, and that interest rate stability, at least from the government yield curve, is somewhat surprising given that domestic inflation would have risen. And the question we're asking is, well, is domestic inflation peaking? Given the latest information that's coming out of the US, one, and the fact that most of our inflation is imported, two, it does suggest that domestic inflation may be reaching a peak. Certainly, if we take tomatoes as a seasonal indicator, I'm much more happy to be buying tomatoes now than I was, 2 or 3 months ago. But there does seem to be some peaking of inflation based on the available information from the Central Bank of Trinidad and Tobago. However, food inflation remains somewhat stubbornly high at that 11.6%. Please note these figures were as of January 2023. Excess reserves remain fairly elevated as well, with excess reserves at around $6.5 billion as at the end of February 2023. What does that mean? It means there's a lot of lending capacity which would stimulate economic activity still lurking in the banking system after meeting their statutory reserve requirements. So that is one good factor, and it does not really argue for necessarily any material increase in interest rates at this particular point in time. So when we take a look at that local bond market outlook and what we see in the tea leaves as we move ahead throughout 2023, inflation may have peaked, but we expect that it will continue to be somewhat persistent. Of course, we have coming adjustments, perhaps to utility rates. There is that property tax that would have been discussed, which could affect investors and consumers' pockets. So inflation, and of course, there's that degree of inflation that is imported as well. So that inflation figure, while it may have peaked or is near that peak, we expect it to be persistently high in those mid to high single-digit levels. Excess liquidity we expect to continue to be fairly robust as well, or more likely, given the drop-off in projected revenues, or the anticipated drop-off in projected revenues from but significantly natural gas production and natural gas prices, more importantly. There could be some material shortfall in the fiscal budget for 2023 in terms of revenues relative to expenditure, and that could mean that one of two things could happen, or both. Some drawdowns from the Heritage and Stabilization Fund might be warranted, and/or an increase in the issuance of domestic debt by the government. And lower interest rates, we believe, are going to continue to be more likely, despite that persistent inflation and despite that increased bond issuance. There continues to be robust institutional demand for government debt, one, and at the central bank policy level, the repo rate is really geared, in our view, more at stimulating economic activity as opposed to containing inflation, which we believe, and which has been reiterated, is predominantly inflation imported. At the international level, when we look at US government yields, they have actually been trending lower from the start of 2022. The 2-year yield, for example, was at 4.4% or thereabouts. It did increase to just around 5% earlier or during the first quarter, but is now down to just about 3.78%, reflecting that inflation is starting to abate somewhat, and that there are expectations that the Fed is not going to be as aggressive in terms of increasing interest rates. In fact, there are some calls in some quarters that the Fed will have peak interest rates very soon and start cutting rates if recession risks continue to increase. Now, that rate in terms of US Treasury yields is changing very rapidly, particularly at the short end, given, well, on a daily basis, given the very contrasting information that comes out on a daily basis into markets and affecting investor expectations and sentiment. So certainly, one of the major factors that would affect not just bond markets, but equity markets going forward would be the Fed's anticipated path in terms of peaking or moving to peak interest rates. And if, in fact, there would be any potential for cutting interest rates throughout the period, throughout the remainder of 2023. Now, this is just a graphical representation of what we're talking about. There has been a very, very sharp increase in terms of the US Fed fund rate, its benchmark rate, moving from near zero in January of 2022 to just around that 5% level at its most recent meeting. And there is the general consensus that those rate increases are going to slow at the very least and perhaps stop if inflation continues to move in the direction it is moving in. And when we take a look at the consumer price index in that yellow line, or US consumer price index or US inflation, we can see that inflation would have peaked somewhere during the middle of 2022 and continues its decline. It's currently at or about that 5% odd level. US personal consumption expenditure index as well, which is another gauge of inflation, has somewhat stabilized and started to marginally decline from that March 2022 or thereabout level, continuing to fall modestly to that 4.6 level as of March 2023. Now, what does that mean for investors? Well, most of our investors and attendees looking at this presentation would generally be investing in some of our TT heritage names that are US dollar denominated, and I say heritage with no pun intended to the actual heritage bond. But the NGC 2036 US dollar bond, for example, that yield would have peaked over the last 52 weeks at about 7.5%. It's now come down and is trading at just around that 7% yield. Heritage Petroleum's 2029 bond would have peaked at an 8.3% yield, is now trading at 7.5% as an example. And Trinidad and Tobago sovereign or government US dollar denominated debt would have peaked at a 6% yield and is now trading around that 5% yield handle. So certainly it seems as though for Trinidad and Tobago related US dollar paper or US dollar bonds, interest rates or bond yields have indeed peaked. Taking a look at the outlook for international bond markets, well, the view, at least of Bourse, is that peak interest rates are leaning towards that more likely column, with inflation appearing to cool and that increase in recessionary risk, as well as the lurking risk of financial market instability, which would prompt policymakers in the main to probably be more aggressive with interest rate cuts if an event did in fact occur, and provide additional liquidity to financial markets. Inflation moderating, somewhat between the less likely to more likely column. It is somewhat persistent. However, as we would have seen in the chart from US CPI data, it is on a downward trend. Bond market stabilization is leaning a bit towards that less likely side, given that there are multiple variables. Again, the Fed interest rate policy path, inflation data, that financial market stabilization, geopolitical tensions, and relatedly, a deterioration or potential for deterioration in credit quality. And as a general rule of thumb, the higher interest rates stay for prolonged periods of time, it does have an effect on the balance sheets and financial positions of many corporate borrowers that could lead to some deterioration in credit quality and or an increase in defaults as we go forward into 2023, and that in itself could consequently affect bond market stabilization or stability in the year ahead. Now, there are a couple of questions which we continuously get asked by our investors and our clients. One is, well, is the central bank's policy repo rate too low, could it increase, and what could that what could that do to financial markets in Trinidad and Tobago? Now, again, as we would have mentioned, stimulating economic growth remains a primary driver or primary objective at this point of the CBTT, in our view. The interest rate differential between US interest rates and TT dollar interest rates is less urgent for the fact that in an open market, there could be the risk of capital flight. But as most people know, it's very, very difficult to go to a commercial bank rather, and get access to any meaningful amount of currency to repatriate, or not just repatriate, but to take abroad or for investment purposes. So in that context, that interest rate differential to preserve or to reduce the risk of capital flight becomes less and less important. Inflation, as you mentioned, is primarily imported, so increasing our benchmark rate does not necessarily affect the rate of inflation if most of it is imported. And of course, the Honorable Minister of Finance would have stated that a very careful stance on the repo rate would be taken to avoid any economic downturn. So with all of those factors, we expect that the policy rate is going to continue to remain fairly low. And devaluation is another question that is always on the minds of investors. Devaluing would be certainly a fairly significant burden on the consumer population, and we view it as a very low likelihood outcome in that context, with inflation already pressuring economic demand and buying power, as well as utility tariff adjustments, which are on the cards. There's still a fairly healthy level of international reserves, as well as a fairly healthy heritage and stabilization fund, despite all of the market movements and machinations that would have taken place over the last few months. And of course, the Minister of Finance would have also mentioned that there is no intention of removing restrictions on FX. Intention is not spelled correctly. I apologize for that. Credit ratings in the near term, we do not expect any material near-term change to the credit rating, despite the energy price deterioration or energy commodity price deterioration that would have taken place. So going forward, we don't expect any surprises to the upside or downside in terms of credit ratings at this particular point in time. Of course, if there is a prolonged deterioration in or low energy price environment, or if there are any downside surprises to energy production or forecast production, that could, of course, change the credit rating outlook for some of these major credit rating agencies. And of course, depending on the level of borrowing that takes place as well, to fund any particular potential deficits or budgetary deficits in the coming few periods. This is just an example of one illustration of the very robust heritage and stabilization fund that we were talking about. Recently, there was a 345 million odd US injection into the fund, given the very sharp fall off in energy prices, however, and that increasingly likely budget deficit, that it could be the case that the Heritage and Stabilization Fund is dipped into to help fund some of the expenditures for fiscal 2023. So with those factors in mind, how would an investor position their portfolio? Now, I want you to bear with me. This is going to be somewhat very colorful in terms of the graph, so we'll go through it together step by step. When we take a look at the major investor risk profiles, well, just as an example, a conservative investor would have 30% of their portfolio, in our view, in cash or near cash instruments such as money market funds, deposits, savings accounts, or repurchase agreements. Just about 50% in fixed income securities such as bonds, and just about 20% in equities, whether local or international, depending on your access to foreign exchange. And it's the same in terms of reading for the aggressive, moderate, and ultra low investor profiles, risk profiles. So an aggressive investor, for example, might have a very, very minimal amount in cash on their cash instruments, 5%, 25% in bonds, and just about 70% in stocks, whether international or domestic. So based on what we see at the current stage and what we anticipate for the rest of 2023, we've made an attempt to determine what might be a more suitable or less suitable product based on an investor's risk profile. So as an example, if we explain the ultra low risk profile, investor risk profile, cash is somewhat appropriate, as you can see, given that inflation is continues to be fairly persistent. So the more appropriate investment solutions for an ultra low risk investor at this particular point in time might be solutions such as income mutual funds, looking at repurchase agreements or other deposit-like or type instruments, and investment grade bonds with a shorter term to maturity, given that the interest rate forecast is a little bit uncertain at this point in time, though we are leaning towards peak interest rates happening sooner rather than later. At the other end of the spectrum, for example, an aggressive investor definitely would not want to be in cash right now. They would want to be maximizing their returns, whether it is through income mutual funds or repurchase agreements. They could also consider investment grade bonds, both shorter and longer term, because those absolute yields would have risen with those interest rate increases by the US Federal Reserve, at least at the international level. Taking a look at speculative bonds for the aggressive investor, of course, where you could get yields in those double-digit figures, 10% and above. But again, the credit quality would be certainly on the lower end of the spectrum. It might be worthwhile to add to your portfolio for the aggressive investor if you believe, one, that interest rates are going to peak sooner rather than later, and two, that you have full faith in those companies that you are going to be investing in or governments that you're going to be investing in terms of continuing to pay those debts in terms of coupons as well as maturities. And of course, at the stock level, equity mutual funds, after a fairly significant correction in 2022, equity markets have advanced at least in the US, about that 7% over the first quarter of 2023. And there is some further upside, around 9 to 10% full year forecast for the US equity market, for example, based on most recent consensus estimates by analysts. So there is some degree of upside at the gross market or aggregate market level. And of course, more aggressive investors tend to take single stock positions. So there are those stocks that would have been fairly significantly beaten down, some still in the technology sector, some in the financial sector, for example, which the aggressive investor may wish to add to their portfolios in the current environment. And for the moderately aggressive investor, or the moderately riskier investor rather, cash is not necessarily a friend at this particular point in time. So having that money in deposits or in savings accounts earning little to nothing is probably not the best use of your excess cash. You could very easily move that to an income mutual fund, such as the Save Invest Structured Investment Fund or US Dollar Investment Income Fund managed by Bourse, shameless plug, which would give you a superior rate of return without taking on any major significant degree of risk. You could look at repurchase agreements. You could also look at investment grade bonds, given that the outlook is that interest rates may peak sooner rather than later, even though there is still some degree of uncertainty. Probably avoid those speculative grade bonds for the time being, given that recessionary risks could mean a deterioration in credit quality for those less financially stable names, and proceed with caution in the equity market. particularly given those several layers of uncertainties or moving parts, which could lead to continued volatility across both regional and international equity markets. In terms of some upcoming investor relevant events, at least within Trinidad and Tobago, there is, of course, the mid-year review, which is scheduled usually between April and May, and that will really give an update as to the fiscal position of Trinidad and Tobago and provide an overarching macroeconomic update, which will inevitably drive investor sentiment, perhaps to the downside, given what we would have observed in terms of languishing energy prices at the global level. For investors in NIFs, the Series A will be maturing in August 2023, so that provides an opportunity to reinvest. It's very likely that there will be a rule of that particular bond to a later maturity, or for new investors to perhaps take advantage of whatever investment opportunity comes out of that particular maturity. And finally, in a fairly quiet pipeline for upcoming investor relevant events so far, the Bryden's IPO and cross listing, which was spoken about with much fanfare towards the end of 2022, has been somewhat delayed. Recent publications would have suggested that that is still very much on the cards for a Jamaica listing at some point during 2023, with the intention of a cross listing towards the end of 2023 on the Trinidad and Tobago Stock Exchange. So certainly equity-minded investors would be looking forward to this particular cross listing, given the attractiveness of, or the potential attractiveness of the name. It's a very long-standing name within the Trinidad and Tobago space. And of course, just the excitement surrounding a new addition to the Trinidad and Tobago Stock Exchange's investment opportunities. And with that, we will bring it to the end of the official presentation, and we will open up our question and answer session. I see that the Q&A segment has been buzzing somewhat, so I'm going to invite our moderators, Shona and Carissa, to perhaps shoot a couple of questions across, and I will do my very best to answer them.
Okay, good afternoon, everyone. We got a few interesting questions so far, so let's get started. The first series of the NIF bond matures later this year. What do you recommend for an investor with a moderate to low risk appetite?
Okay, so that's a really good question. So the fixed income market, if you invested in the NIF, the fixed income market is fairly lackluster. You would have bought that NIF bond with a 5-year maturity. So if I'm looking at, or if I was an investor with, buying that Series A, I would imagine that I'm not going to look for an investment that has beyond those 5 years to maturity, which really limits your fixed income options in the current environment. So in the event that NIF does in fact reissue about another 5-year security, it might make sense to pick up or reinvest in that particular tranche. It is a fairly attractive security in terms of the collateral to debt ratio, where for every dollar in bonds that is issued in issuance rather, there is at least $2 in collateral within the NIF. So certainly reinvesting could be a good opportunity. You could also look for other fixed income opportunities on the exchange traded side of things. There's not really too much activity on the government bond market across the Trinidad and Tobago Stock Exchange at this particular point, save and except for the J314 bond, which is the bond that was initially in the Clico Investment Fund, which is now exchange traded. However, that's a 2037 maturity. So you're talking about, if my maths doesn't fail me, about 14 years to maturity. So perhaps a little bit on the longer side of investment opportunities that you could actively pursue. You could look at repurchase agreements, and from time to time, depending on your investment size, private opportunities may become available as well. So that would really much sum it up in terms of a lower risk appetite. For a moderate risk appetite, which is the second part of the question, I guess you could You could probably look at some dividend yielding stocks, some of the major more stable companies that have fairly predictable dividend yields and trading at relatively attractive valuations at that point in time of maturity. You could probably take a look at, and of course, give us a call, and we'll be more than happy to provide some guidance at that time. Next question.
Do you think Whitco revenue challenges will continue?
Well, I think there are still a lot of headwinds for Whitco. I think one of the major things that they have been confronting has been that illicit trade a matter, or suspected illicit trade matter, where contraband has been entering apparently the market, and it's just been on an absolute basis cheaper because it's not subject to the sort of taxes that because legitimate products have been subject to. Now, full disclosure, I'm not a smoker, so I can't attest to how good or not good the brand is. But suffice it to say, the company has been very strong in terms of their brand loyalty over the past couple decades. So this is particularly a headwind that is a bit difficult to call. If there is a clampdown on that type of contraband activity, it could mean a material increase in Whitco's revenue. However, it is notoriously difficult to address those types of activities. So I think it may be one of those headwinds that Whitco continues to endure in the near term. That's on the revenue side. I think one of the notable issues with Whitco recently was that there was a measurable decline in its operating margins. And that, in our view, would have been primarily attributable to supply chain challenges, which are now starting to abate. So we're cautiously optimistic that Whitco's operating margins should improve. And even with very marginal decline in revenue to flat revenue, but with those improving margins, that there could be more upside to the stock at this particular point in time.
Okay. What is driving the drop in the forecast prices of oil and natural gas?
Well, 2022 was certainly an abnormal year. Russia invading Ukraine was never on the cards for anyone, and that really caused severe dislocation across energy commodities, agricultural commodities, you name it, anything that was related to do with that region. And it would have sent commodity prices soaring, oil and natural gas. And that is now starting to moderate to some extent. We've seen that on the one hand, OPEC would have cooperated and increased production quotas to help stabilize energy prices throughout 2022. They've now started to cut back a bit on their production as well, going forward, again, to try to balance the market. And generally, with the recessionary outlook or concerns of recession at the global level increasing, that would speak to some measure of reduced demand for energy-related commodities, and that could also be driving prices lower. So that combination of one, in 2022 in particular, severe market dislocation, and two, normalization of markets now, and the likelihood of, or growing likelihood of recession, is starting to bring energy prices down. So certainly, if we look back pre-2022, natural gas prices weren't trading at that $6 per MMBTU handle in the recent past prior to 2022. This is more normal-ish levels, if you'd like to put it that way. So next question, please.
Okay, next question. Do you have a crypto portfolio?
No, we do not have a crypto portfolio, thankfully. We are believers in fundamentals, and at this particular point in time, there's a lot of unanswered questions with respect to crypto, one, and two, a fairly significant lack of regulation for the markets. And we saw over the past couple of months, what would have happened to FTX and Alameda Trading, where billions practically disappeared overnight due to, as one lawyer put it, quote unquote, good old fashioned fraud. So we tend to stay away from those highly unregulated type of investments. Okay, next question.
Okay, so next question. This investor is interested in BRICS investments and would like an email address to contact a broker rep at Bourse.
Okay, you can just email invest@boursefinancial.com for that particular investment opportunity or any other investment opportunity. So thank you for that. Next question.
Next question. Do you think NEL will be able to maintain their dividend payments?
Excellent question. So NEL would have benefited, like other energy and energy commodity related companies, from that fairly significant windfall going into, well, throughout the course of 2022. Realistically, any rational investor would assume that with a correction in ammonia prices and other energy commodity prices, there should be a correction in earnings or some less robust earnings relative to 2022. Having said that, naturally that would have an impact on the amount of dividends that NEL would be able to pay out over the next couple of months or couple of years. Having said that, one of the reasons we like NEL is not just because of the dividends. I mean, we would have had an overweight rating on NEL for quite some time before they did in fact declare fairly robust dividends. But it's just from a relative value basis. I mean, the stock is trading or was trading at roughly half of what its net assets were worth. So from a value perspective, we do still have an overweight rating on NEL. Even if dividends do normalize, we still like the stock, and I mean, it's trading at that between 350, 370 sort of level, and the value of the net asset value per share of NEL is closer to that $7 handle. So I mean, there is, in our view, a deep value proposition for NEL, and that dividend yield, that generous dividend yield right now, even post normalization, it does create a pretty compelling story for NEL.